What other issues do you think investors are concerned about and is driving behaviour at the moment?
I think it kind of boils down to that. There's lots of different dimensions to it, but it's all about the risk and uncertainty around the future. Because if we look at what investors are thinking, this was a survey we did with 270 European investors earlier in the year. It was in March. But fundamentally, most things haven't really changed. And we asked them, okay, so we're seeing yields starting to come back in, capital values starting to recover. What's the single biggest threat to that recovery? What could derail it? And overwhelmingly, people were focused on the economy. I think if we ask the question now, you'd get more people on that government funding deficits issue, but in many ways that's actually a different dimension of the same issue. What people are worried about is either the possibility of a double dip or similarly, a weaker than expected recovery in occupier demand. And that really very clearly illustrates or exemplifies why it is that investors are doing what they're doing, what it is that they're focused on. We said, when is the right time to buy into European real estate? And for prime or core real estate, they said now, either the first half of 2010 or the second half of 2010. 3/4 of them saying now, get in now. When we asked the same question about secondary property, a different pattern. That they were saying, no, it's probably going to be next year, maybe even the year after. And I suspect that if we redid this survey now, it would be even more marked. I think that people are probably pushing further out those prospects for recovery.
Yep.
And what's really driving this is concern around the weakness in the occupational base. That if you look at, here in the UK, what we've been doing is every month we put a spot yield onto prime property in different sectors. But we also, measuring secondary is very difficult, but we also have a definition of what constitutes secondary. And so we say, well, what's the secondary yield? And what you can see is that at the top end of the market, or the peak of the market, that difference between prime and secondary, the yield spread was only 50, maybe 100 basis points in many sectors. With the onset of the GFC, those spreads have blown out. So whatever happened to secondary yields, this happened to prime yields, this happened on top to secondary. And we haven't really seen that spread coming back in at all. And the reason for that is twofold. Firstly, there was an expectation that we would see loads and loads of bank sales coming through into the market, and that hasn't actually happened. We haven't seen the flood of secondary property. But the second factor is that there is a real difference between investing in prime and investing in value add. If you invest in prime, the previous chart, what you're looking for is a longer-term cyclical upswing. When you're investing in secondary, you are far more exposed to the short-term movements in occupational demand and in the economy. Because if you're buying a property now that you're going to need to relet, maybe you've got some voids or there's an opportunity to take it out of the market, refurbish it and bring it back to the market, you're really exposed to what tenant demand there's going to be out there in a couple of years' time. And, kind of back to where we started, it's desperately difficult at the moment to have that view as to what things are going to look like. The important thing is to play in that value-add active management space, you don't have to be at the bottom of the market. But what you do have to have is a reasonably clear view of when and where you think that bottom's going to be and what the trajectory of recovery is. And at the moment, that's almost impossible to have, which means that it's very, very difficult to price the secondary area of the market. How much risk is in there? I don't know, and nor do the investors. And that's why this market is very thin. There aren't many people buying into it, and people are remaining focused at the prime end of the market.
Well, I think that's a similar theme here, and it's certainly a similar theme around the world at the moment. I mean, even in the US, we're seeing secondary values continue to fall, while prime has stabilised. So a wide gap between the prime and secondary capital values in the US as well.
That's right. This is more sort of transaction-based, but it shows fundamentally the same thing, this spread between prime and secondary. And it's certainly a characteristic everywhere that people are risk-averse. That's influencing their behaviour. In terms of where are we going to go from here, well, we've said all along that we think that this is going to be a slow and bumpy recovery, and I think we're kind of seeing some of those bumps coming through at the moment. From our point of view, the very strong yield compression that we've seen in the European market, we think is drawing to a close. It's difficult to see what would push yields much lower, given the fundamentals that we're seeing in the market. But The real key is on the occupational side. We expect values to kind of bump along in Europe over the course of the next year or two. There'll be some bigger periods and some weaker ones. And probably the best parallel is if you look at that period in the mid-1990s, so just after the first dark shaded bit on this chart. And you can see that what happened was the same as we're seeing at the moment, which is initially rents still falling, but yields starting to compress in anticipation of a bit of recovery. But we then had a period of a couple of years where values didn't really move much in total, yields bouncing around, some slight weakness coming through in the rental market. And that's kind of the same picture that we expect to see coming through over the course of the next couple of years, but for very, very different reasons. If you look at what happened prior to that 1990s recession, what we had was a period of extremely strong rental growth. And that, in turn, fueled extremely strong development activity. So as we came out of recovery, out of the recession in the 1990s, demand actually started to recover reasonably positively, but there was a huge oversupply of real estate in the market, which meant that it took a long time before we saw rental growth coming back into the market. This time, the picture's kind of reversed. We expect to see something broadly similar, but it's because of weakness in the occupational markets. That those austerity packages, the weakness in the economic recovery, is going to mean it's going to take a long while for employment and demand to come back and start driving the market. But if there's a positive, it's on the supply side. Because if you look at that last cycle, yes, it was yield-driven, but the magnitude and the duration of the rental growth that we saw in the market was actually quite a lot lower, much lower than we've seen in previous cycles. That meant that the development cycle was lower to kick into gear. And, of course, one of the first things to be pulled when the GFC hit was development funding. So a lot of schemes were pulled off the drawing board before they got under construction. So if we look at the supply picture from a construction point of view, it's much more positive. Look at the volume of development completions that we saw coming through 6 years in the 1990s, where we saw over 4 million square meters of office development completions. That's more than the peak that we saw in this cycle. The number of years, the volume coming through into the market was much lower, and it's going to tail off much more quickly. So what that means is that although it is going to take time for economies to recover and for employment to come back and rental growth to come back, when the economy does start to move and tenant demand does start to come back into the market, the preconditions are there for a much quicker return to rental growth than we saw during the previous cycle. We have to say we are focused on supply-side stories at the moment. When you're making an investment, generally you're either buying a demand-side or a supply-side story. If you buy a demand-side story at the moment, there's going to be a strong recovery here. It may well be correct, but it could be wrong, and things are changing very quickly. If you buy into a supply-side story, then that's not likely to change. There's not a lot of development finance out there. There is not a lot of appetite for getting into particularly the spec development market in most cases. So therefore, that story, at least you can rely on that it's probably likely to be delivered, although the timing is going to be dependent on the economy. And the reason that we're seeing so much activity focused on certain markets is because London and Paris happen to actually have quite a sweet spot at the moment. Because if you think about where we are in terms of pricing, it doesn't look bad structurally. If you look at the supply situation, look over on the right-hand side, you take the current vacancy in the market and the space that's being developed, London and Paris look very positive. In fact, they're so positive that because there's not much vacancy in the market, even the relatively small amounts of tenant demand that we see coming through, because there's no supply, are starting to put pressure on rents. We saw rents in the City of London go up 8% in a quarter recently. So from that point of view, given that they're also very large liquid markets, there's a real concentration of activity around there. Doesn't mean people are buying everywhere, but there is a real justification for the focus that we're seeing from investors on those core markets.
Mm-hmm. Yeah. So there's a story in behind that bigger picture, isn't there, Nick? And I think that's really kind of the lesson of what we're seeing at the moment in the research world too, of not just pulling back that chart you had before of the overall trend in supply, but looking beyond that, market by market, to see where the opportunities might still be.
Yep, absolutely.